Hello and welcome back to the Microlearning Institute. In this short tutorial we look at IAS 21 foreign exchange and we look at some simple transaction examples. In foreign exchange example 1 we consider a company A whose functional currency is the dollar, and this company on the 1st of the 12th 20x1 A buys goods on credit for €100,000 when the spot currency exchange rate is €1 equals $2. So let's look and see how A would account for that. So firstly, it's the 1st of December x1. We've engaged in a commitment for €100,000 at a time when €1 equals $2. So consequently, we must recognize $200,000 of a liability on our statement of financial position. And again, we recognize the inventory that we've purchased at $200,000 and we recognize accounts payable both at cost of $200,000. Now, moving on, we see that on the 31st of December 20x1, which is A's year end, the spot currency exchange rate moves to €1 equals $2.1. So let's look at this. So at the 31st of December, we still have a liability to our supplier for €100,000. However, the exchange rate has now moved to €1 equals $2.1. So consequently, €100,000 now translates to $210,000. So even though we have the same liability to the supplier in euros, the liability has increased from 200,000 on the 1st of December to 210,000 on the 31st of December. So therefore, we recognize a 10k loss to profit and loss in relation to this foreign exchange movement. Now, next we're told that on the 1st of February 20x2, when the spot rate is €1 to $2.05, A pays $205,000 to settle the €100,000 liability. So let's look at this. It's the 1st of February 20x2. We eliminate the €100,000 liability. But in order to do that, because the exchange rate is €1 to $2.05, we have to write a check for $205,000. Now, this $205,000 is less than the $210,000 we had recognized as a liability to this supplier at year end. So consequently, we also, with this transaction, recognize a corresponding $5,000 gain to profit and loss. Let's look at another example now in relation to foreign exchange transactions. In this example, once again, we're told that A's functional currency is the dollar, and we're also told that on the 1st of December 20x1, A buys an investment property for €100,000 when the spot currency exchange rate is €1 to $2, and that is A pays $200,000 to acquire this property. We're also told that in line with IAS 40, A accounts for the investment property at its fair value. So again, on the 1st of December x1, we purchase an investment property for €100,000 and the exchange rate is 1:2. Therefore, we recognize the investment property at €200,000. So again, this was the amount that was paid to acquire the investment property. So again, we reduce our cash and we recognize the investment property at cost. Next, we're told that on the 31st of December x1, which is the financial year end for A, the fair value of the investment property is €100,000, i.e. it hasn't changed, and the spot currency exchange rate is now €1 to $2.1. So again, at the 31st of December, the property is still worth the same in euro. However, due to a foreign exchange movement, the property is now worth $210,000. So the property has gone up in value from $200,000 to $210,000 in the dollar-denominated books of A. So what we do with this now is we recognize a 10k fair value gain to profit and loss. Okay, so again, this is a fair value gain on the investment property, and in line with IAS 40, this is recognized directly to profit and loss. Thank you very much for watching this short tutorial on IAS 21 foreign exchange.